Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I really have a fascinating young gentleman to introduce you tonight. Jeffrey McCain is his name. He is the CEO of a private equity company by the name of Woodward Capital. He's got a really interesting background. He comes from a well-known family. We'll probably talk about that a little bit, what the benefits and challenges are of coming from a well-known family. But he's also come back to Canada after a very successful career internationally and both academically and professionally, to start a private equity group that's going to be investing in owner-led businesses, and really try to grow a brand new private equity business in the marketplace. And so I think that's fascinating. We're also joined by Mark Borkowski. He is the president of Mercantile M&A, and he's going to be able to give us a sort of a market wider view of what's going on in the M&A, the mergers and acquisitions business today. Jeffrey McCain, welcome to the show, sir. How are you?
Doing well, Brian. Good to see you again. Thanks for having me.
So I understand you just came back from Atlantic Canada, Halifax, where you spoke about this topic, about strategic purchases and financial purchases. What was the reception? Were people interested in the market?
Yeah, so it was a great conference, Brian. This is part of a multi-city, multi-geography series by the Business Transitions Forum. So I was on the steering committee for Atlantic Canada for their event there, and was on one of the panels, which had a fireside chat around different types of buyers, right? Strategic buyers, private equity firms, traditional private equity firms, and then family office or independent sponsor investors, and what they're looking for and how they think about doing deals, right? And so really interesting discussion. Most of the attendees are business owners themselves, actually. So it's a lot of a focus around them thinking through whether they're going to grow their business or perhaps transition their business to new ownership, right? And so a really healthy discussion around those topics.
I'd like to come back to your own personal background in a minute, but tell me about your business, Woodward Capital. What are you trying to do?
So I launched the fund about a year and a half ago, and the thesis is to look at small to medium-sized businesses in Canada, typically in the $5 to $25 million revenue range, Brian, which translates roughly into $1 to $5 or $6 million in profit per year. And there's a plenty of amazing companies throughout this country, and I realized that there was a lack in focus around the market for founder-owned and family-led businesses, of which that's a background I understand well. And so I've specifically targeted those types of companies that are looking to transition ownership from one generation to the next, and are also looking for a partner with a very long-term view on that ownership period and permanent capital.
Why that specific market, owner and family-owned businesses?
Well, one, I understand it well. So it's an easier system to navigate personally. But I also find that there's a lot of elements of those businesses where there's plenty of room to grow. They just need a new generation of ownership. And so if you're part of that transition and providing a solution for succession, which is normally where this is driven. So if you look at the Canadian Federation of Independent Business, they've put out a study that would point you in the direction of $2 trillion of small to medium enterprises that need to transition over the next 10 years. Now, this isn't a new problem, Brian. We've seen this before in the past. This is a part of the baby boomer generation, right? And so there's a lot of companies that those founders of those businesses are reaching retirement age, and they're thinking about what they want to do with those businesses.
$2 trillion worth
Big
of
number.
Value but my God, that puts that increase in capital gains tax in perspective. If 8% of that value is going to go to the federal government.
That's right. Yeah, it's quite a transition that's coming from one generation to the next. And my experience has been most of it, the majority of this is retirement driven. And so you've got a lot of owners that are looking to take that next step. And one of the challenges around this is the data would tell you that most do not actually have a succession plan. So more than half of business owners don't have a formal written plan of what they're going to do when they exit their business. And so that's where we kind of step in and say, look, we're an alternative, right?
Because the kids don't want to take over the business that mom and dad started, or they're not capable, or both?
Usually well, it's very specific to the situation, but I'll give you a fictional example. I mean, if you've built a wonderful plumbing business, you got 20 vans and you've got 40 employees, and you got a daughter that's a doctor and a son that's a firefighter, they're probably not going to be interested in taking over the business, right? And so you're left with a problem of, do I pick someone internally that I think can manage it, or do I partner with someone on the outside that will bring a different level of expertise and perhaps can bring in the resources to grow that business and carry on the legacy, right? I think that's the most important piece. Is when you talk to owners, they really are thinking more than the money itself is what's going to happen to my people, right? When someone else takes over and is continuing the legacy that I've built here.
The challenge for you is you're going to come with the money, and you're probably going to come with some strategic direction and sit on the board, but you're not going to get out there and run the plumbing business. So what are you going to do to actually run the business?
So in some cases, I'm actually willing to take a seat in the management of the business. I think it's a little bit based off of the time frame around that, right? I've come across a number of situations where the need is immediate, right? Like, I'm going to have to step into a CEO type role for a period of time, certainly, to help with that transition into finding whoever's going to be the permanent seat and the next general manager of the business. And then I've come into other situations where it's more liquidity event driven, Brian, and really what we're looking for is a new majority owner, but there might be somebody already in place within the management team that's a logical person to step up, take on more responsibility, and take the reins in the day-to-day management of the business. So it's very dependent on the particulars of that, what those needs are for that company, but we're willing and flexible to tackle all of those situations.
I met and interviewed Frank Stronach recently, and he really liked the small, medium-sized businesses far more than the larger business, and thought that, I can't remember, I think it was over 150 people. He thought that there was a real diseconomy to scale. And he also thought that even though he brought the money, he thought it was really critical to give some equity to at least the top management, if frankly not in some cases, all of the employees. Do you give equity to some of your top managers?
What our focus actually is, we tend to have the majority of the economics in the business, right? We tend not to be minority investors unless it's a specific situation where our intent is to be passive, right? I'm looking to be active in the ownership and the management of the businesses that we look to partner with. And so what that means, typically what I'm looking for is actually for the previous owner to keep a little bit of skin in the game, right? During that transition period. There's always mechanisms later on to have a full exit, but in the onset, we tend to look for 80 to 85% ownership, and the existing owner will retain some equity, of which that will either be replaced by us or the existing management team, like you said, Brian. So we'll come up with a combination that works well and flexible to those situations. But in many cases, there could be someone within the management team that also wants to invest in the business, right? A younger person, perhaps not the owner of the company. And we love giving those opportunities for people to feel like they've got skin in the game when they're running the companies with us.
Let's bring Mark Boakowski into this conversation. He's the president of Mercantile M&A and sees this from a market-wide standpoint. Mark, two questions, if I could. Do you think this is a good idea? Is there a good market for Jeffrey McCain and his in his objective of buying some of these $2 trillion worth of small and medium-sized companies that are potentially transitioning to a next generation? And second question, are some of them willing to leave 15% of their value, their profit, in the business for a while, I presume it's called like an earn-out or something like that?
It's an absolutely wonderful idea because most of these private businesses don't have logical buyers. So Jeff coming along with his group and making these acquisitions is very good for the market. Most owners are very amenable to keeping 10 or 15% of their equity in the business. They see a fair transition. And frankly, if you structure the deal in such a way that it might be an earnout, there's an upside. So many of these owners will say, look, I have a higher expectation than what you're proposing to me. However, I believe that under your ownership, you're going to do significantly better than I will. So I'm prepared to leave 10% of my ownership in the business. in an earnout, they can get an upside. They can get a premium to that 10% in terms of, some increase in profit. But on the downside, they may have overpromised. If they've overpromised, then their value of that last 10% may be smaller. However, great time to be a seller of private businesses.
Do you agree with Jeffrey that there's $2 trillion worth of private businesses potentially on the block for sale in the next couple of years as the baby boom generation transitions to retirement?
And that's in Canada. And I believe that number could be significantly higher. I mean, we are seeing all kinds of businesses in every segment coming to market. So there's lots of opportunities. What we require are strong buyers like Jeff that bring value to an equation.
Jeffrey, I did a deal at one point in time. I worked for the Molson Company, so this wasn't a small, medium-sized company, but I worked for the Molson Companies. We owned a company by the name of Iconit's Home Improvement Warehouse, which was a reasonable facsimile of Home Depot in the United States before Home Depot came to Canada. We sold it to Home Depot. We sold 75% of it to Home Depot for $50 million, but we kept 25% for another, I think it was 7 years, which we sold for $425 million. So, that earnout, that leaving a little bit in, particularly obviously because we sold to an incredibly powerful, good company that was going to grow it dramatically. Gosh, multiples, almost a 10 times multiple on that last 25%. We're going to take a break for some messages and be back in just 2 minutes with Jeffrey McCain of Woodward Capital and Mark Borikowski of Mercantile M&A, talking about the small and medium-sized M&A market in Canada and Jeffrey McCain's launch of his private equity firm, Woodward Capital, as it tries to buy a small share, maybe a big share of $2 trillion worth of businesses that he thinks is going to come up for sale in the next couple of years. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Really interesting conversation tonight, talking about really the future of small and medium-sized businesses in Canada. My guest is Jeffrey McCain. He is the CEO, founder of Woodward Capital. It's a private equity group that's really targeting buying founder, owner, and family-owned companies that are going through a transition as the owner retires. He says there's $2 trillion worth of small and medium-sized companies in Canada that are prime for him and other people to come in and purchase. And Mark Borikowski, who's the president of Mercantile M&A, we've had the pleasure of chatting with Mark, I think twice before on this show about the M&A business more generally and what's happening in the market. And I think Mark thinks the market is back after a couple of years of challenging times during the pandemic and high interest rates. Jeffrey, I got to ask you, if I could, tell us a little bit about yourself. You spent almost a decade, I think, outside of Canada.
Yep.
You were born into a pretty well-known family in Canada writ large, but also in Atlantic Canada and particularly Toronto. Tell me a little bit about your background and why you decided to come back to Canada.
Sure. So originally from out east, I was born in New Brunswick, but grew up in Toronto, moved here at a fairly young age, around 5 years old. And so I went to school here, went to undergrad a couple hours outside of Toronto, went to Western, and moved to the US shortly after I graduated. For me, it was at that time just an opportunity to jump to a new geography. And I was pursuing a career path in investment banking, and New York was the Mecca at the time, still is in many regards, right? And so for me, it was logical to try to cut my teeth in the US market, and started working at a boutique investment bank there for a number of years, then moved over to Goldman for a number of years, but all in an M&A capacity. So I never really focused on any particular industries, but more broadly was focused on working with private equity firms, strategics, and capital raise type transactions across a whole suite of geographies. It wasn't just the US. Out of New York, they run deals for North America, South America, and Europe. And so it was really, really amazing learning opportunity to be plugged right into that.
I worked in M&A for Morgan Stanley in New York, and I interviewed with Goldman. I got to tell you, congratulations for getting a job at Goldman. I went through the most rigorous 2 days of interviews at Goldman. I flew down from Boston. I remember And I was asked for an interview. I thought, maybe an hour or two Saturday morning. It was all day Saturday with interview after interview after interview after interview, and then all day Sunday, interview after interview after interview. It was unbelievably intensive.
Not an easy path for sure. I was fortunate enough to have spent a few years in the industry, and then I lateraled over to a similar position at Goldman from a boutique investment bank. And at the time, it was a very small team. This was a group that was focused exclusively on sponsor M&A transactions, which is just financial sponsor, private equity investors working on those types of deals. So helping private equity firms buy companies, sell companies, and raise capital in growth situations for those businesses. Believe it or not, it was a very small team. Goldman Sachs is a very big organization, but when I joined, it was about 12 people that were part of my team. And a couple of years later, when I left, there were about 150. So it was a high growth environment for a big financial institution. So it was a very interesting time to be there.
So, working with Goldman Sachs and M&A on Wall Street must have been unbelievable. I think most people that are listening tonight probably don't have a sense of what it was like, other than, Richard Gere in Pretty Women, or who's the guy in Wall Street, or Gordon Gekko.
Gordon Gekko, yeah, Gordon Gekko.
So are you Richard Gere, or are you Gordon Gekko?
I'm definitely neither. Maybe I'm the manifestation of them when they build a bit of a conscience after they've gone through some life experiences. So for me, when we think about,
that was Richard Gere later on.
That's right. Yeah, exactly. That's Richard Gere part 2, right, Brian? So, it's very interesting because for me, when you think about the small to medium-sized business market where you're targeting, you've got a lot of founder-owned, family-led enterprises where the people are the forefront of the business, right? And treating people well is priority number one, especially when you're talking to an owner that's transitioning the ownership of the company to a new company, a new entity, a new person in my case. And this is serious stuff. It really matters. I mean, the small to medium businesses in Canada are half of our GDP and represent 80% of Canadian employees. And so this really matters, and it's a real challenge, and it's an opportunity as well. But
80% of all our employees. That's interesting. Half of the GDP, 80% of the employees. You think about all the attention all the big companies get, and you're saying 80% of the employees work for small and medium-sized companies. That's incredible.
That's right. Yeah,
Jeffrey, I got to ask you. You come with a well-known name, Maple Leaf Foods, McCain Foods, the McCain family. Your father, your uncle, your grandfather, extremely well-known business people. Having that last name, is it an advantage or a hindrance?
Well, for me, I truly believe it provides a unique experience, right? Growing up in a family business environment, it was very normal for me to have those discussions at the dinner table. That's just how I grew up. And for me, it informed a lot of the background of what I was looking to do in my career. Actually, I was looking to get out there, work hard, find ways to kind of expand my own horizons. And I ended up spending the first chunk of my career in investment banking because I knew that would be hard and be a great learning opportunity. And so I pursued that path. But in the back of my mind, I always knew that, one, I would go home. And so after 10 years abroad, it was logical that I would make the move back home. And part two is that I would spend the rest of my career doing something that was related to founder-owned and family-led businesses, because it's just a market that I understand really well. I'm comfortable operating in those environments where you've got family members in the business working with you day to day, and all of the intricacies that entails is normal for me. And so it was logical for me to target businesses with that type of background.
Sounds like an interesting experience that you've had. You also have an MBA, I understand?
That's right. I jumped around a little bit in my career, Brian. I would say from the ages of sort of 20 to 30, I was in London, Ontario, Hong Kong, New York, London, England, California, and then back to Toronto. So I've jumped around quite a bit, and it's definitely a pleasure to be home and get reintegrated back into all the fun stuff going on over here. But that time abroad was a really valuable learning opportunity for me. And when I was in the UK, I did my MBA there at London Business School and moved back home shortly after I graduated to launch Woodward Capital.
In California, we're in Silicon Valley, San Francisco area?
I was in Palo Alto, worked there for a couple of months at a fintech startup. My wife was also going to school in that area, and so spent some time with her. Actually did an exchange program for one semester with London Business School at Berkeley, which was a really interesting opportunity to spend some time in that geography before graduating. So bounced around a little bit for sure, but it was an opportunity to spend some time, a little bit of fun in the sun before making my way back to Toronto.
Jeffrey, you've lived in Toronto, New York, Hong Kong, Silicon Valley, Palo Alto, and London, England. You know, there's this big controversy between, you know, and best sort of described by a guy by the name of Thomas Friedman, who wrote the book The World is Flat, that said because of technology and global travel and stuff like this, you can be anywhere in the world and do business. And then Richard Florida, who says, no, the world is spiky. You got to be in one of those major cities because of the interaction between people and social capital and the agglomeration of money and patents and good ideas and people and, you know, et cetera, et cetera. What do you think? Is the world flat or is it spiky?
You know, I'm probably somewhere in between, because my observation is that if you look at some of the largest companies in Canada, plenty of them operate in small communities, and they're integral parts of those small communities. And they're like small businesses in those communities, right? If you've got a plant that, you know, half the town works at or it drives by every day, you're fully ingrained with the very fabric of what's going on in those cities, right? And of course, there's it's natural to have hubs in bigger cities like in New York or a Toronto where you might have a headquarters. It's a great place to pool talent. But at the same time, if you look at what's happening underneath the hood, what's driving those businesses is usually a lot happening in smaller communities that is integral to the Canadian economy, but also integral to the very foundations of those towns, right? And so if you don't have to drive too far outside of Toronto to realize that there's plenty of amazing family-owned, founder-led businesses driving distance from the city, driving the distance from any major city, that are really actually the backbone of the economy.
So it's not flat, it's not spiky, it's lumpy.
Yes, yeah,
thesis, exactly. According to Jeffrey McCain.
Yeah, there you go.
You've got, I understand, and please correct me if I'm wrong, a father that runs a pretty successful business and an uncle that runs a pretty successful business. Do you get involved in telling them what to do, or they get involved in telling you what to do?
Oh, well, that's the fun part of family business, Brian. There's plenty of interesting discussions at home. But no, the reality is that for us, we have spent the last number of decades at McCain Foods, certainly, transitioning to professional management. And so there's not actually that many family members working directly in the business. And we've taken this from a more of a philosophical view. If you're not working in the business, you can work on the business. And so as an owner, you can spend a lot of time thinking about the long-term vision and what you're really trying to achieve and who's going to do it. And I think it's really translatable directly to small to medium-sized businesses as well, because most of the discussions I have around succession and transitioning companies is who's going to be taking over, in what capacity, and how do I, as the owner that's involved in the day-to-day operations, remove myself from that responsibility as part of my retirement plan, and who's going to help me do that, right? And so I think whether it's a big family enterprise or a small to medium-sized businesses, these are similar challenges where at some point those transitions need to take place, and sometimes you need help to do that.
Jeffrey McCain, this has been an interesting conversation. We're going to take a break for some messages and come back with Jeffrey McCain and Mark Borokowski. Jeffrey is founder and CEO of Woodward Capital, private equity firm that's targeting the purchases of $2 trillion, not him personally, but the marketplace of $2 trillion of founder-led companies that are going through a transition. as they get, I guess, into older age and think about retirement and cashing out. And our other guest is Mark Borkowski, who's the president of Mercantile M&A, who advises companies that are interested in selling. We're going to come back after the break and talk a little bit more about the actual process of either buying and or selling and how big this market is. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Wire on Saga 960. I've got an interesting conversation tonight about really the M&A market for small and medium-sized companies, the mergers and acquisitions market, that is. My guests are, number one, Jeffrey McCain, who is the founder and CEO of a private equity company by the name of Woodward Capital. Jeffrey comes from a well-known family business, but he's starting his own private equity firm that is targeting founder-owned companies that are really transitioning as the founder wants to sell out and buying them, which is kind of interesting because it's, not the typical, merger and acquisition that you see on the front page of the ROB and the Globe and Mail. And he thinks that he's got a specific knowledge because of his family background and his M&A experience on Wall Street, and I presume a little bit of money you got in your genes that you can use to spend to buy those companies. And so that's an interesting strategy. We also have Mark Borkowski, who is the president of Mercantile M&A. His firm is a 35-year firm that specializes in advising some of these companies that are putting themselves up for sale, which I think has got to be a pretty challenging thing for someone who's run a business for, 40, 50 years. The kids don't want to take over, and you think about putting it up for sale. It's got to be pretty challenging. So, Jeffrey, let's start with you. How do you find these companies?
It's a great question, Brian. A lot of it is getting the brand out there and building a bit of awareness around what we're doing. We do have a fairly specific offering, and we have a fairly specific criteria where we're really long-term investors, right? So we're not a typical private equity firm that will look to own a business for 3 or 5 or 7 years and then flip it to somebody else. We take a permanent capital lens to our investing, right? And so I believe that that's typically very important for founder-owned and family-led businesses when they're looking to make that transition. They're looking for someone who's going to run it for another whole generation. And we tend to have that long-term view when we're investing as well. I've got a 30-plus year horizon ahead of me here, and we're excited to put some capital to work.
That's interesting. So, Mark Borkowski, when you're selling businesses, I would have thought you'd want to sort of, market it to absolutely everybody. But do you have vendors that are specifically interested in what Jeffrey's describing, someone that's going to hold it for 30 years, or do they don't care? And if someone wants to sell it in 5 years, so build it up and sell it in 5 years, they cashed out. They don't care. What do you think? Is there a wide market that you're going to market to, or are you going to target it to send it to your teaser to only a few people like Jeffrey?
Typically, we do a very wide distribution. However, that distribution goes to groups that have specific criteria. Jeff hasn't talked about his criteria, which he should, areas of great interest. So there's no point me showing Jeff an opportunity in paper converting if he has no interest in the paper converting market. We would target that opportunity to all the players in the market because we buy data. We know who are the paper converting potential buyers and strategic buyers, private equity buyers, family offices that own paper converting companies. We would target to those groups. We might contact 300 or 400 of these groups internationally to find the right fit. In Jeff's case, Jeff's got some specific criteria, areas of interest. So he should talk about that.
Jeff, I've heard, statistics like 80% of acquisitions fail. And you're not a strategic buyer right now. You're a financial buyer. So to Mark's comment, can you compete with the strategic buyers?
Strategic buyers tend to usually have a very specific thesis around why they're acquiring a business in the first place. I would say we're fully capable of competing with strategic buyers, but we would have to have just as compelling of a thesis, right? And if you're thinking about a new industry or a new platform for us, then we tend to look for what's more important is the right operating partner or the right person that can help us run those businesses if it's not going to be me in the management team. And that's more important than competing directly with a strategic buyer. If we have a thesis that's just as strong, then I think we're just as competitive in the process ultimately.
What do you mean by a thesis?
So if you're, let's say, an HVAC company, and you're talking to two different potential buyers. So you've got a financial investor and a strategic investor. A strategic investor might be able to acquire your business for a higher price because they can cut half the management team and half of your employees because they already have them. And so you just get plugged into a bigger beast. And so what they're able to extract out of the business could be more than what we would bring to the table, because we have a completely different thesis, which is we need everyone that's part of this team and we want to add to it. So that's a very different way of investing. And ultimately, that will come down to the owner of the business as to who they think is the right partner for the next generation of ownership. In some cases, a strategic investor can help you grow the business in a way that might be really beneficial to both of you. But in others, it could be the wrong cultural fit for your organization. So ultimately, my best advice for small to medium-sized business owners is there's a bit of soul searching required in this process before you go to the market. And you want to have a good sense of what the ultimate right buyer is for you before you go down that path.
So you really are Richard Gere Part 2, not Gordon Gekko or Richard Gere Part 1. You're the builder of those businesses. Mark says you have a criteria of what industries you're interested in. Can you give us a sense of that?
Absolutely, Brian. So the easiest way to think about this is we tend not to do extraction businesses. So that would be oil and gas, metals and mining, businesses that are too real estate heavy. Those would be companies that are around taking things out of the ground, right? And so we don't have a background in that type of investing, so we tend to stray away from those types of opportunities. But other than that, we've looked across every geography and every sector since I've started the fund a year and a half ago. So genuinely from coast to coast, from Victoria Island to Fogo Island, every province and all of the territories. And we've taken a look at companies in manufacturing, industrial businesses, healthcare, technology, business services type companies. There's a lot of really amazing business services, B2B type businesses out there. And those are certainly the type of companies that meet most of our criteria, but we've looked at everything and we'll continue to do that. We've got a wide lens.
Marks, what's your sense of most purchasers? You hear the line about stick to your knitting. Do most purchasers stick to only one industry, like, food processing, or are they wider the way that Jeffrey's describing?
Well, there is a category. There's a category of buyers that tend to fall into the category called family offices. And so I've sold companies to family offices that have companies in the metal industry to a beauty college. And they have a collective management group that manage all these businesses very successfully. So for the most part, the majority of private equity firms focus on industries that they know something about or can add value to. But it's very wide. It's very open.
I worked for Jim Pattison for a while, and he was in every business you can imagine. But he did have one criteria that he says it's got to be a business I understand. And so yes, it was a very wide conglomerate is the way one would describe it, possibly. But he kept each one of those businesses separate with a separate management team. We had a small group at the head office that had oversight and did mergers and acquisitions and financing and strategic work, etc. But it was always businesses that he understood. So Jeffrey, are all the businesses business that you understand?
Yeah, it's a great point, Brian. I think about it the same way. The easiest way to describe this would be if I'm having a coffee with a business owner and in 10 minutes I don't understand what they do, it's probably not a fit for us.
So
there's a bigger criteria. There's a bigger criteria. The number one criteria, if you don't like the people, walk away. And that can happen within the first 10 minutes.
But you're selling the business or you're buying the business, not the people. So why do you have to like the people, Mark?
I mean, it's all about people. You're only buying two things in buying a business. You're buying cash flow and you're buying people and management. And of course, there's assets. Those are the two main things that you're buying in buying a business. cash flow and people. And if you don't like the people, we say to potential buyers and sellers, this is not the right fit.
You know,
Yeah,
I
I think
can't
it's a
agree
really
more with you. I think that people take a look at the financial pro forma and they do their valuation that you say that you can do in 4 hours, and they take a look at all those numbers. But in the end, it's the people that make those numbers sing and make it either profitable or unprofitable. And you've got to have trust and confidence in the people that are going to be managing the company. Jeffrey,
Right on.
how do you get a read of people? How do you assess whether the management team are the type of people you want to work with and can trust to run your money?
it takes time, Brian. You know, this is one of those situations when you're thinking about one, marketing yourself, you're getting out to conferences, you're talking with brokers like Mark, who I've worked with plenty in the past, facilitators that are helping create these opportunities for introduction and spending time with owners, right? And that can be business broker advisors, investment bankers, lawyers, accountants, all capable of making introductions to business owners. But ultimately, you have to spend time with them to understand what they've gone through, what their hopes and desires are in transitioning their business, but also what they've built underneath them, right? If you've run your business like a dictator and most of it, all of the business knowledge exists within you, that's a transition challenge, right? That's a transition problem. And ultimately, as an investor and a buyer, and in some cases, someone who steps into the management team, the type of culture that exists underneath the owner is paramount to success, right? And can be the difference between a successful deal and a complete failure. And so for us, we spend a lot of time up front understanding those dynamics. And ultimately, I completely agree with Mark. Capital is one piece, but it's really about the people. And finding the right operating partner for us is very, very important. And that's a go, no go type of conversation.
You know, that's really interesting that you say that some of these companies that are run like a dictatorship are really problematic. And I guess that makes intuitive sense. Jimmy Pattison used to have a line, went something like, the true test of leadership is if you could groom a successor. Do you agree with that?
Wholeheartedly.
That's interesting. So Mark's not going to like this, but some people think that if you win an auction, you lose because you paid too much. So do you go and receive all these pitches that Mark and other brokers sent to you, and do you participate in a bunch of these auctions, or do you try to go out and get your own organic opportunities?
A bit of a combination of both, Brian. You know, when you've got someone like Mark that's helping facilitate a deal, it's really helpful in terms of transparency around the information that's being gathered. And a lot of the tougher conversations that you would have with an owner have already taken place, right? So Mark has had conversations around tax implications and structure implications and what's going to happen to your people when you leave and when you're transitioning the business, right? And if I'm doing something that would fall under their proprietary category, so I called the business owner, wrote them a letter or sent them an email, and that struck up a conversation, that tends to be very early on in the process. And so what that means is that they may be in the very, very early stages of considering to sell their business, and it could be months, if not years, before they get to a point where they're willing to do that. If you have an advisor that's already had those conversations, you're sort of one step ahead. So there's a lot of advantages that come from that. But at the same time, sometimes it's best to just pick up the phone and call owners and have a good conversation and do it yourself. And so as an investor, we have to really delicately balance those priorities because there's pros and cons to both approaches.
I'm buying or trying to buy one business right now out of receivership because I think it's a good opportunity. Would you do that?
We tend to look at businesses with a 5 to 50-year history, operating history, that are already profitable. We're not really startup investors. We're not restructuring investors. There's situations where if we are already in the industry, we might have a different angle, right? I think that if you're talking about businesses that have insolvency related issues, but you're already in the industry and you know exactly what to do with that company, that's very different than investing in a new platform in a new industry where you're coming in and looking to build a business. you want to start from a position of strength. And so for us, that tends to be a long history of strong cash flows, strong growth, and good layer of existing management below the owner, where there's a wonderful starting off point that we can build the business from.
Mark, maybe 20 years ago or so, all the business in this sort of buyout area, I think was sort of called leveraged, and leveraged buyouts were the thing. And then during the last, 10, 15 years, I heard a lot of people talk about roll-ups, that was the thing. And so they were sort of, the first one was a financial, but then it became strategic after that as they tried to roll up an industry. Are there trends like that you're seeing in the marketplace?
We're certainly seeing some consolidation taking place in different industries. At the moment, we saw it in the dental market. All dentists were contacted by a variety of different private equity organizations. We're seeing it today in the heating, ventilating, and air conditioning market. We're seeing it in all the trades, plumbing, the insurance industry, insurance brokerages. There's a roll-up taking place, and the big players are buying up these insurance brokerages. So the roll-ups continue. Consolidation continues. But in Jeff's case, Jeff's looking for independent businesses that they can use as a platform and build on. And more than likely, after they made one acquisition, building on it by acquiring other related businesses makes a lot of sense.
What kind of returns are you looking for, Jeffrey?
It's very situation dependent. Generally, the returns in the small to medium sized business market are very compelling. So north of 20% IRRs. And that's because it's not a very well understood market, Brian. And so you've got amazing companies that in some cases are not on the radar of a larger strategic or large private equity firm that is looking to deploy millions, if not tens of millions of dollars of capital at the same time. And these businesses don't meet that mark, right, in many cases. But they're amazing companies that have really, really interesting growth prospects. And so when you find these situations, the returns are quite compelling, which is why we've decided as a firm that we're going to focus on those small to medium-sized businesses that meet those criteria and are looking for help to get to that next level.
And that 20% internal rate of return, IRR, is that after debt or pre-debt? And is it after tax or pre-tax?
That would be after debt and after tax in many cases. Now that depends on the business that you've bought, and Mark would know well, there's a lot that needs to happen in the background around structuring and being very thoughtful about how you're structuring a deal to prioritize growth, but also the stability in the business, right? So you can't come into a situation and say, I'm going to just make these returns happen through financial engineering, right? You can't just over-lever a company and then handicap your ability to grow the business. So there's certainly a balancing act that needs to take place, but this creative and thoughtful structuring will get you there. The returns in this segment are very compelling, and that's why there's folks like me out there looking for these types of businesses.
So I got to ask you, if Justin Trudeau increases your capital gains tax rate by effectively 8%, going from a 25% inclusion to a 33% inclusion, and so therefore that final exit ends up being 8% less beneficial, do you now need a 28% IRR to be equal to the 20% IRR that you had right now?
Yeah, it's certainly, this is not welcomed news by the small to medium-sized business community. When people have spent, in many cases, years, if not decades, doing tax planning around a specific outcome, and you change it, then you're in a situation where there's a lot that is unknown. And that's not a place that any business owner wants to be in when they've been thinking about transitioning their business. And it will impact the returns for investors. And generally, it's created some new challenges in the ecosystem for sure, Brian.
You know, it's interesting because I had an interesting debate with someone the other night as to whether people like you would still make the same number of acquisitions, or if your cost of capital actually was higher now because every return is going to be 8% lower. would you make the same number of acquisitions, but you're going to have to bid effectively 8% less. And so therefore the people that get hurt are the vendors that are going to get 8% lower because you're going to be demanding that same 20% return, and you're just going to be paying 8% to the federal government rather than to the vendor. And I think it's interesting. It's, you know, it comes back to that old adage of does the marketplace adjust for tax rate changes? And so therefore it's really the current owner that is impacted, or are you going to, the way that they describe, end up paying 8% more than you otherwise would have? And I don't think you're going to pay 8% more than you otherwise would have. I think you're going to just reduce your pricing. But that'll be an interesting academic study in about 10 years to see what happens to the marketplace. Mark, I got to ask you, are there lots of people like Jeffrey out there trying to buy companies, or is Jeffrey unique?
There's, for the record, there's about 4,000 private equity firms in the US that have about $500 million of captive capital. Again, all of them have specific criteria in markets that they're currently looking in. There's an incredible amount of money looking for private mid-market businesses. And as Jeff talks about a 20% return, we're talking to groups that are doing 30 plus. So private business is the place to be.
Jeffrey, if there's business owners listening to the show tonight that are interested in chatting with you to see if you're the right shepherd for their company long term, the Richard Gere #2 that's not going to destroy their company, or the Gordon Gekko that's going to pay them the best price, how should they best contact you?
So you can find me on my website, woodwardcapital.ca, WOODWARD capital.ca. You got all my contact details on there. A little bit more on my background and also the types of businesses that we're looking to invest in. And so feel free to reach out. All the details are right there. And if you're a business owner out there that's thinking about transitioning your company, feel free to give me a call.
Jeffrey McCain.
Call him first.
CEO,
call
founder.
him first. Call Jeff first.
Jeffrey McCain, CEO and founder of Woodward Capital, and Mark Barakowski, president of Mercantile M&A. Thanks so much for joining us. I really appreciate it. We're going to take a short break and come back, and I'm going to chat with Mark just about the market in general and what's happening. But Jeffrey and Mark, thanks so much for joining us.
Thanks very much.
Back in 2 minutes. Stay with us.